Dan, thank you for joining us. I don't know if you had a chance to listen to some of what Brian Deese had to say, but a lot has been telegraphed already. What do you make of another chunk of money getting out there into the economy and what it will do to rates?
Well, thank you, Vonnie. We're engaged here in the U.S., and I think Canada is somewhat joining us. My historical reference is the financing done for World War II. Now, that may seem strange to a lot of people, but what it was is that the risk to the economy, to the society, was an overwhelming risk. So that we obviously had to finance the war buildup, and we also had to say, all right, our central bank has to go along with this because we have an overwhelming risk. And that's what happened. You got the accord between the Treasury and the Fed. And that went on as long as the war went on, and then gradually tapered off and then sort of rebuttressed the economy when the Korean War broke out, and then wound down, and finally the Fed was free of that a little bit past the middle of the 50s. And that's what's going on now. Now, this causes a lot of people to worry about, well, wait a minute, aren't we going to wind up with a lot of inflation? Well, that could well be. I mean, that's a very, very, very valid concern, because you look at the expansion of liquidity, you can measure it with the Fed's numbers on M2 or something like that, where you have a record expansion of liquidity, and it's finding its way into the markets. How this is handled once the virus is fully contained, and that means internationally, that means worldwide, will depend on what sort of a level of instability most likely to be in price inflation for goods and services do we encounter, if any. I would say it's too early to make your bets. Right now, the overwhelming thing is that we do have the excess liquidity and is supporting the markets. It's holding down the cost of federal borrowing and of anything else on the borrowing, private borrowing side. So that's the setting. How long, Vonnie, this is going to go on, I don't know. We'll see.
Dan, if it's too early to make an inflation bet, that's not really something you have the luxury of resting on. What bets do you place in that context? How do you think about your investing given that fact? Well,
I'm being very cautious, quite frankly, perhaps overly so. But you watch your maturities. This is no longer a time to run out and buy 30-year zeros or anything like that. You'll have some, depending on the liabilities that you're investing against, you'll have some on the longer end of things, but much shorter than normal. And you want flexibility in here, because the market that is so supported by liquidity now is probably going to continue to be supported by liquidity. But I use the word probably, not certainly. We have, and not all that many years back, we've had several instances where on the fixed income side, the bid has vanished. And you say, well, that can't happen this time because the Fed is there. Yes, that is true. What if something happens to interrupt that? Then where's your bid? At this level of rates, but more importantly, the aftermath of this, the impact on credits, is basically, again, another unknown. I'm being extra cautious on the credit side now. I think the credit risk is increased.
Yeah, now, it does seem like the percentage of your BAA-rated bonds are higher, about 10% higher than in the index. You do have about 26%, it would seem, at that rating of bond, Dan. Is that what you mean by cautious? And if I could just also ask you if you agree with the Federal Reserve that inflation won't be a problem for several years. It sounds like you don't, or that you're not sure.
I'm not sure.
Yeah.
That's it. You know, there's a pattern you can follow based on experience, but that pattern is not perfect, and the ability to follow it is not perfect. From a fundamental value basis, as you move down the rating scale, particularly when you get into the double B, but more particularly the single B and below, you have to say in many cases, not all, but in many cases you have to say keepers. This credit profile doesn't look all that good. Am I being compensated for the risk here? When I look at a lot of these, I say, no, not. So therefore, don't be there. And the question then becomes, okay, what do you do in substitute for that? And how much liquidity do you need? And your circumstances vary, obviously. Depends on the particular account. But I'm more cautious than I've been now in quite some time as to both credit and the possibility that the bid-only function of the market might get back to normal or deteriorate. And we haven't seen that yet, and there's a lot of confidence by a lot of people based on what the Fed has implied from what they're doing, that we don't have to sweat that. I don't share that confidence. I just don't.
So we don't have a ton of time, Dan, but that's a really important point. You've said here, you know, we could go no bid. The Fed is there to backstop, but that could change. What would change it in your view? Why are you worried about that?
Things don't always play out the way intended. Mechanical things surface in the markets. The most likely of these remote chances, or maybe not so remote, is that you have something go wrong in the markets themselves. I mean, the Fed doesn't change your mind. They don't come out and scare the market. But something mechanical in the market starts to develop, and it isn't noticed until too late. What could that be? Is it going to be in the U.S. market? I don't know. I would bet that it's going to be somewhere in the international flow of funds. It's probably going to be brought to light by a political development of some kind. But this is speculation now. I don't want to give a scary analogy because I don't think that's valid. We're dealing with low-risk possibilities, but there are enough of them to worry about the bid side of the market being there if you need it.